Hi, I hope you all are doing really well. This is Ritika and we are doing reading 30th of corporate issuers called Cost of Capital. We are now on LOSC, which requires us to calculate and interpret the cost of debt capital using the yield to maturity approach and the debt rating approach. So here we'll be discussing both these approaches for calculating the cost of debt. Let's begin with the YTM approach. So what is YTM? Yield to maturity represents the annual yield an investor earns on a bond if it is held to maturity. It represents the return you would receive each year if you purchase a bond and hold the same till the maturity. Are these yields different for different bonds? Well, yes. If the bonds are issued at par, its YTM equals the coupon payments. And what if they are issued at a premium or a discount? If the bonds are issued at a premium or discount, its YTM or the cost of debt is lower or higher than the coupon payments respectively. So if the bond is issued at a premium, its cost will be lower, and if it is issued at discount, the YTM would be higher. The logic is simple. If you are an issuer and if you receive more money at the time of issue, obviously it is cheaper and thus the YTM is low, and vice versa for if you issue the same at a discount. It will be costly as you receive less money and yet you have to pay the same amount of interest. Don't worry if you didn't understand this. We can explain this with the help of an example. Now suppose we have a $100 10% 10-year semi-annual bond issued at a market price of $110, which means we have issued the bond at a premium. The actual cost of capital can be calculated here using your financial calculators, and we'll use the IRR function here. So basically there are two steps involved here. First we calculate the semi-annual IRR and then we annualize the same. And we do all this on our financial calculators. Here's how we do it. Let's begin. First we'll clear any previous data on our calculators. Press CF, then second, and finally CE/C. Now the data is clear, you can start entering the data now. We have issued the bond at $110, so enter the figure and make it negative using the sign plus minus. Press enter and then down button. Next we enter the outflows. We pay half of 10%, that is 5% in every 6 months. So there are 19 payments of $5 each and a final payment of $105 at the end of 10th year. We'll enter this data now. So enter 5, press enter and then down. Now set the frequency to 19. Next we enter the last outflow of 105, press enter and then down. The frequency for this outflow is 1, so simply press enter now. Now calculate YTM of this bond. Press IRR and then CPT. So we have got this interest rate in percentage form. To convert this into annual rate, we first convert it into decimal by dividing this by 100. Now add 1 and square it. Subtract 1 from the resulting value and this is our annualized YTM. In percentage term, our annual YTM is 8.6763%. If, however, the rate of tax is 40%, the after-tax cost of capital would be this figure multiplied by 1 minus tax rate or 1 minus 0.40. So we multiply this by 0.60. So after-tax cost of this bond to the company is 0.052058 or 5.2058%. I hope this clearly explains the calculation of YTM. Now we move on to the debt rating approach. But before we begin, let me clarify. The best way to calculate the yield on a bond is through YTM approach using the market prices of the bond. If, however, the market price of the bond is not available, we can calculate the yield on the bond using the debt rating method. So this should only be your secondary choice, not the first option. Under this approach, we first take our company's debt rating, We then use the yield on comparably rated bonds in the market for calculating the cost of debt of our company. So like if the bonds of our company are rated BB+, we'll take the bonds of the company in the same industry whose rating is also BB+. You should also make sure that the bonds that you are taking have a similar term of maturity, options and other terms. And once you find such a bond, you can take the yield on such bond as yours. Here the pricing is done on the basis of valuation relevant characteristics such as market rates, returns, risks, seniority of bonds, etc. And it is also known as evaluated pricing or matrix pricing. There are certain issues that need to be considered and adjusted for before using this approach, and they are whether the interest rates are fixed or floating. The companies need to make the relevant adjustment for the floating rates here. Then second, if the debt comes with an embedded option such as convertibility, etc. or not. There's a value to this option that is attached to the bond, and you must make adjustment for the value of the option when comparing the same with the bond that's without any option. Then third, sometimes the debt that you're comparing may be a non-rated debt, and that may also be an issue. And fourth, you could also have leases, and these should be included in the cost of capital. Let's do a couple of questions. The first question says, the cost of debt can be determined using yield to maturity and bond rating approaches. If the bond rating approach is used, the option A, coupon is the yield. That's while using the YTM approach, and that too when the bonds are issued at par. Option B, yield is based on the interest coverage ratio. Where does this option come from? Anyways, option C, company is rated and the rating can be used to assess the credit default spread of the company's debt. This is correct. So option C is correct. Now the next one. .com has determined that it could issue $1,000 face value bonds with 8% coupon paid semi-annually and 5-year maturity at $900 per bond. If .com's marginal tax rate is 38%, its after-tax cost of debt is closest to A 6.2%, B 6.4% or C 6.6%. We did this in the previous video. You can pause the video now and solve the same for practice again and see if your calculations are correct. The correct answer is option C. So that was LOSC. Practice as many questions as you can on calculating YTM and debt rating approach. You can find the questions for your practice at ProCFA.com. If you have any problem with the concept of this topic or any other topic, feel free to write to us. We'll get back to you as soon as we can. Take care and see you with the next topic.